Um, I'm very excited to be introducing our next speaker, Cassian Drew. Cassian leads Inclusive Growth Partners, an investment and transaction advisory firm that develops investment partnerships around governance, environmental and social values. Cassian has advised on and has led public-private transactions across service sectors, infrastructure and natural capital, including water and large-scale environmental assets. Cassian has had roles including as managing partner of a global international development and impact investment firm, a senior executive advisor on economic development to the Abu Dhabi government, served in UK to the Office of the Deputy Prime Minister. Cassian previously has held consulting career with Deloitte and a global strategy firm called Booz & Company. Cassian is a board member of the Natural Capital Economics. He's a fellow of the Queensland Academy of Arts and Sciences and holds a Bachelor of Engineering from QUT, Queensland University of Technology, MBA from the London Business School, and has studied at Harvard University and University of Oxford. His topic is inclusive economic development, imperative for attracting investment and capital into the region. Please welcome Cassian Drew.
Thanks, Sheree. When I hear the introduction, it's quite overwhelming. There's a lot of stuff there. What I'd like to talk today about really builds on Alan's and John's remarks, looking at the economic development issues in regional Australia from the lens of investment. Just a preamble on my slides, they're designed to be read independently as well. So I'm going to just talk about some of the big concepts, but move through the slides fairly quickly. In my discussion today, I'd like to cover the lenses on rural economic development of inclusive economic growth, layering that on a place-based approach, and then talking about some of the investment considerations. I'll start with a bit of a context. Probably members of this audience won't be strangers to the fact that inequality is alive and well in Australia. It's often described as having a postcode. What we're looking at pre-pandemic was a situation where the average wealth of an Australian household sat above $1 million, which was 90 times at the top of the tree, in the top 20%, 90 times that of the bottom 20%, which is a substantial inequality consideration. And we're considering inequality both from the perspective of income inequality and from the wealth inequality perspectives. Just in general, Australia, and we're looking at economic development, there's a number of inherent challenges in Australia, one being the distribution of the population. Although it is largely centralised around the major cities and its surrounding suburbs, the areas with high incomes tend to be the most unequal, and it's visible inequality in particular there. Both cities and regions have unemployment issues, although, as indicated in the bottom left-hand map of Australia, those rural and remote areas obviously have the largest levels of unemployment, typically above 10%. The other factor is demographics, and that the population density in terms of aged population typically is concentrated in Victoria and New South Wales regional areas. So that's sort of the setting of how we think about where we're investing and how we're growing rural economies. There are three factors to look at here, or common considerations around when we're looking at the planning aspects. The first being top-down versus bottom-up. We've heard a little bit about that today in some of the other speakers. We could take a top-down view, which looks at an aspiration of what we wish to achieve, and then develop a sort of an investment vision and a strategy under that, which would then seek to develop economies regardless of current resources and current constraints. The bottom-up approach is the inverse, looking at what do we have on the ground, again, against a set of aspirations, but what are our constraints? What do we have to work with? What are our natural endowments and natural competitive advantages, and build on those? And it's quite an important consideration. Abu Dhabi is one example that I've had experience with. where the top-down approach was clear, an ambition to diversify out of oil and into high value, high productivity economic sectors versus looking at what they had in their current portfolio. The second area around balancing local economy with participation in other markets. So are we building an economy which is truly a local economy, or are we building market access and infrastructure into global supply chains? And then the third balance is around how we look at focus on key anchor tenants in the economy versus building out a broader and deeper economy. So the first question here is what is inclusive economic growth? The definition that I commonly work with is around enabling equitable distribution of the benefits of economic growth, and that's including to investors, including to the broader society and to the environment. Inclusive growth was originally coined by Columbia professor Joseph Stiglitz in 2009 in work he was doing in the UK and France around transitioning coal and manufacturing economies into higher productivity and greater employment opportunities. And if we just look at this definition for a minute, I mean, we're looking at a couple of key themes in it. One being there is a concept of growth. Sometimes there's an argument against growth and sustainability. What I'm talking about here is growth in the context of potentially increasing productivity and expansion of the economy, but also increasing its depth and the distribution and participation in that economy. And then the second piece there is around the distribution. And when we're planning an inclusive growth approach, that's the thing that we really focus on, is how do we ensure that the benefits of this are distributed? And that includes distributions to the environment. It includes distributions to a broad section of society. So the four lenses that we look at here when establishing an inclusive growth approach, first and foremost, you need to have a sustainable economy. So you need to be focused on economic activity. It needs to have investment opportunities, and that comes with the opportunity for financial returns. Typically, it can involve innovative finance mechanisms, which would include, as Alan's just highlighted as well, around environmental finance. And there's often an opportunity for catalytic capital participation, which is where, whether it's government or philanthropists, where people with an interest in these broader non-financial outcomes can take a capital position in the structure, which would de-risk investment for other investors. It's important that metrics aren't just financial, that the planning and the ongoing evaluation of the performance of this work seeks a broad range of metrics, including health and well-being, for example. The second area is around governance and establishing a system of governance which would promote more inclusive democratic decision-making. It often links to physical place, and so looking at the local resources on the ground and then the established systems of governance, whether that's local or state, and participation and interaction between this place-based governance and the existing established governance structures is important. Quite often investors will be looking for the ability to participate at a precinct level, which gives them the opportunity to configure land use and look at different ways of driving return on capital employed. And that needs to be dynamic as the project evolves. The next feature is around capacity building and ensuring that there is ample opportunity to build capacity both in the market and within individuals. And then last of all, a really important factor is that an inclusive growth approach is multi-party. It is not bilateral. It is not government to big player. In fact, quite commonly, you would seek to ensure that government is not the dominant actor in the equation, which is a difficult transition in many cases, because in economies with lack of depth, government naturally plays a strong and dominant role. But in order to catalyse this growth and stimulate the economic activity, it really does need to be between economic actors. Layering on this then, we look at place-based approaches. This framework here is one that's been used in Australia. It just draws a distinction between a place-focused approach and a place-based approach. This distinction primarily being that in a place-focused approach, government has a very dominant role it involves decision-making in consideration of the community aspirations, but ultimately the decision-making does rest with government. What we need to do is move to a model where government acts to enable communities and the decision-making is shared between government and community. So that's a focus on enabling and partnering from that government perspective. The other aspect that government considers in the place-based approach is that it's a shift from portfolio to outcome focus. And that's really a big barrier in many cases because funding, decision-making and laws are often aligned with portfolios. And therefore, when moving to an outcome focus, you're looking to achieve much more integration across portfolios, which would include multiple departments being involved and requires decision-making across multiple ministers. So inherent to our structure in Australia is a challenge in actually shifting to an outcome and integrated focus. This slide here is a framework that's been used in a couple of the projects that we've been doing in Australia, in particular around transition of coal economies. I won't go into all the detail, but fundamental to it is building on a foundation of a specific geographic location. So this integrates the place-based focus, identifying local priorities, needs, but then capping it with a governance structure that enables that participation that we've described. There are three factors at the top here around driving the process through impact investing principles and impact measurement, around having a vision and an integrated strategy that aligns with a spatial plan, but also having an inclusive growth and transition plan that enables leadership across multiple organisations to align and collaborate. The boxes in the middle of this framework really at the top level talk to needing to drive the investment through local investment opportunities, SME participation, supply chain opportunities, education opportunities, skills development, and employment opportunities. And that's then supported across all sectors, but with a focus on things like affordable housing and infrastructure and social, transport, health, and economic and technology. Finally, in terms of the investment considerations, if we think about from an investor's perspective, and I might just focus on institutional investors, the definition of institutional investors being investors that pool capital, super funds being common. They're governed by regulation and a strong framework for investment. They can choose to deploy capital through direct investments themselves or through asset managers. Quite often at that end, the scale of capital is important, and so you'll be seeing in excess of $100 million per placement. So it's quite difficult to do those deals, often in smaller regional economies. Markets could be public or private, but the considerations that they have is often that the portfolio balance and the volatility that the economic or the investment opportunity presents may conflict between asset classes. So if I'm an investor, I'm looking at putting a large scale of capital into a rural economy, how different is the characteristics of that economy from what I've already got? How easy is it to exit? What's my time frame? How liquid will that investment be? Who will be the secondary buyer if I'm to exit now? Other factors include things like FIRB in Australia, and if I've got foreign investment in my fund, what processes do I need to go to and how public do those processes become, exposing the deal? Just in the interest of time, I'll move through this last section quite quickly. This is an example of an investment case for a number of different renewable energy options in a small town. Investors will look at this from the perspective of, I need to have capital outlays over time in the near future, but in the long term, I'm going to get returns. So in this case, you can see the blue and the green bars show that there's negative returns for the first 10 years, and then it starts to turn positive in the long run. But it comes down to that time value of money and the net present value of those cash flows. If someone promises me $100 in 25 years versus giving me $100 today, I value the $100 today more greatly. And they therefore discount any promise of future cash flows by a substantial amount. What this means in terms of making an investment decision is I look at the total value of my costs today versus the total value of my returns over time, discounting for that risk of will they come in 10 years or in 25 years. And there's often a viability gap. The higher the risk rate, the lower the values of those future cash flows are. And therefore, in this equation here, we see that our costs are far greater than what we'll actually get back. This is where government and where philanthropists can step in with first loss credit enhancement. The government might take a position in the capital structure promising to take the first losses in the first few years, which will greatly de-risk that investment and cause more investment appetite into that opportunity. Finally, the last slide here really looks at some of the current investment opportunities we're seeing around Australia. There's a lot of focus on sustainable and affordable housing. It's a real asset, bricks and mortar, as they say. But this needs to be linked then in rural economies to industrial development. So if I'm setting up a facility in a rural economy, let's link it to affordable housing to enable those workers places to live. Is it a health precinct, hub and spoke, using technology and telehealth, building a hospital in one regional centre, but then having hubs and spokes around other regional areas? And last of all, the thematics around climate adaptation and natural capital are strong, and it's seeking a lot of alternative investment today. That's all from me.
Thank you very much indeed. That was a lot to get through in
Sorry,
a very
everyone.
difficult short period of time, but a lot of food for thought. Any initial comments or questions to Cassian?
I think everyone's in shock.
Everyone's in shock. So Cassian, a lot of local government tries to attract investment, and I know that there's different levels in which investment attraction is targeted. Sometimes it's trying to get the big players from outside the region, but in very sparsely populated regions, that's harder, bigger geographic areas. And sometimes they look at that local investment from small business. And so in your thinking around inclusive growth, what's the sort of the balance around some of those issues? Because often local government and local economies struggle with that.
Oh, absolutely. Look, I think that majority of local activity is bilateral and transactional. Therefore, it's seeking one big player to come in and will you invest here and bring your activity into my town. That's got a lot of inherent risk for the investor. Because rarely do entities exist in silos in economies. So there's a lot of supportive infrastructure required around those organisations. From an inclusive growth perspective, you'd want to ensure that the local participation was possible. So if you bring in a giant, plonk it in the middle of a town, how does that benefit trickle into other sectors and other areas of the community? So often it can create a greater inequality divide, in fact. So you need to really plan for it. And the approach really is around an architected economy where you're saying, what I want to do is I want to move from what have we got today? What's the current productivity of that? What does the output look like? What's the inclusion of skills and participants at a workforce level and at an investment level? And then what's the future state look like? How do I create a more diversified local economy? What are the range of different actors that might be involved in that? And how can they work as a portfolio together? So rather than going to one big player, what if I create, whether it's a cluster model or it's an I think much more preferable now is an ecosystem model, which factors in also things like environmental services and other kind of non-traditional assets. And that requires leadership at the local level and capacity building in local councils to be able to understand that we need to go from transaction, we know these people, what's the deal we can do, what's the incentive we can create, to actually, here's a planned approach, here are a number of different incentives and offsets. I'm going to have a whole bunch of partners on the investment side ready to go in advance of approaching market actors and bring them together in one. And so whether it's through a forum or some sort of summit around, this is the opportunity, creating a prospectus based on natural capital advantages or natural other comparative advantages. It's a bit of a big bang, high risk, but I think that's the way to do it.
Great. We did have another question saying, I think you've partially answered this. What changes, big or small, could we make to the current local, state, federal government structures that might improve regional investment decisions and efficacy?
Look, I think the pragmatic aspect of this is, if you look at what's happening in Australia today, and we're looking at the national governance reforms under the National Cabinet and the COAG reforms, we're seeing a lot more appetite for integration and streamlining of government at all three levels. The city deals and the regional deals have been, exemplars of integrated decision making and creation of, a more streamlined approach to approvals. Whether that's big or small, I don't know. I don't know if that's bigger, but I think creating more integrated structures is definitely the right approach. And to be giving equal voices, and often you'll see it's quite difficult for federal to work with local. There's a bit of an aversion to that. So how do you give an equal voice and create a structure where you've got actually some, and navigating the political divide, of course, some ability to catalyse top right through to bottom from a governance perspective, but then match that to the investment market.
Great, thank you. We've got lots more questions. I'm just going to read them, so some of them we can pick up at the panels. One of the proposals put forward for the DAF low emissions pathway work was to explore net zero emissions pilot regions for Queensland. What would this look like in practical terms in an inclusive growth model, if an inclusive growth model was applied to this concept? Perhaps, Alan, you may want to comment on this. So we may pick that up in the panel. The other is, how do you assess whether an inclusive growth project has succeeded? What metrics would you use? So if you would like to think about that, while we move on to the breakout sessions for about 15 minutes, you all have a lot of input, and I know you've been patiently listening to our speakers, fascinating as they were. It's now your turn. So we'll break out into the breakout groups for about 15 minutes.